Cost accounting has traditionally focused on the technical aspects of tracking and allocating costs within organizations. However, an often overlooked yet crucial dimension is the human behavioral element that significantly impacts how costs are managed, reported, and controlled. Understanding behavioral cost accounting, the study of how human psychology and social dynamics influence cost management practices, is essential for developing more effective cost control systems and driving better business outcomes. The human element in cost systems. At its core, any cost accounting system relies on humans to implement, maintain, and act upon it. Even the most sophisticated technical frameworks can fail if they don't account for how people actually behave and make decisions in real-world settings. Cost accountants must input data, managers must interpret reports, and employees must follow procedures, all of which introduces human judgment, biases, and behavioral factors that can significantly impact the effectiveness of cost management. Consider how different stakeholders interact with cost systems. Production managers may be incentivized to overstate resource needs to build in buffers. Cost accountants might choose allocation methods that make their department look better. And employees may gain time tracking systems if they feel the measurements are unfair. These human dynamics can undermine even perfectly designed technical systems. The psychology of cost control. Understanding the psychological factors that drive cost-related behaviors is crucial for effective cost management. Research has shown that people often make irrational decisions about costs and resource allocation due to various cognitive biases. For example, the sunk cost fallacy leads managers to continue investing in failing projects because they've already spent money on them. Loss aversion makes people more focused on avoiding losses than achieving equivalent gains, which can lead to overly conservative cost management. Individual decision-making biases. When it comes to cost management, individuals frequently exhibit predictable cognitive biases that affect their decision-making. Confirmation bias leads people to seek out information that supports their existing beliefs about costs, while ignoring contradictory evidence. The overconfidence bias causes managers to underestimate costs and overestimate their ability to control them. Understanding these cognitive patterns is crucial for designing systems that can counteract or accommodate them. The impact of emotions. Emotional factors play a significant role in cost-related decisions. Fear of failure can lead to excessive padding in cost estimates. Pride and ego can prevent managers from admitting when cost-cutting initiatives aren't working. Stress and burnout can impair judgment around resource allocation. Successful cost management systems must account for these emotional dynamics rather than pretending they don't exist. Social influences on cost behavior. Cost management doesn't happen in isolation. It occurs within complex social systems that shape how people behave. Organizational culture plays a massive role in how seriously employees take cost control initiatives. If the culture emphasizes quality over cost, workers may ignore efficiency opportunities. Similarly, peer pressure and social norms around spending can override formal policies and procedures. Leadership styles also significantly impact cost behaviors. Autocratic leaders who impose strict cost controls without explanation often face resistance and workarounds from employees. In contrast, leaders who explain the rationale for cost management and involve employees in the process tend to see better compliance and engagement. Group dynamics and cost management. Group dynamics heavily influence how costs are managed in practice. Teams may develop shared beliefs about what constitutes reasonable spending that may not align with organizational goals. Social loafing can occur where individuals reduce their cost management efforts when working in groups. Understanding and actively managing these group dynamics is essential for effective cost control. The role of incentives and motivation. One of the most powerful behavioral tools in cost management is the incentive system. However, poorly designed incentives can backfire spectacularly. When organizations tie bonuses solely to cost reduction targets, they often see gaming behavior, short-term thinking, and degradation of quality or safety standards. The key is aligning incentives with both cost goals and other important business objectives. Intrinsic motivation also plays a crucial role. Employees who understand and buy into the importance of cost management are more likely to actively look for efficiency opportunities versus those who are just following rules. Building this motivation requires education about business fundamentals and creating a culture where cost consciousness is valued. Designing effective incentive systems. Creating incentive systems that drive desired cost behaviors while avoiding unintended consequences requires careful consideration. Financial incentives should be balanced with non-financial recognition. Short-term metrics need to be complemented by longer-term measures. Individual rewards should be aligned with team and organizational goals. Regular review and adjustment of incentive systems helps ensure they continue to drive appropriate behaviors. Common behavioral pitfalls in cost systems. Several predictable behavioral patterns tend to emerge in cost management systems. Understanding these can help organizations design better approaches. Information asymmetry and gaming. Managers and employees often have better information about actual costs and efficiency opportunities than their superiors. This information asymmetry creates opportunities for gaming the system, like building slack into budgets or hiding productivity improvements to maintain easier targets. Regular auditing and creating psychological safety for sharing information can help combat these issues. Responsibility avoidance. When cost systems are complex with shared accountability, there's a tendency for people to avoid taking responsibility for cost management. The diffusion of responsibility psychological principle explains why everyone assumes someone else will handle cost control. Clear ownership and accountability structures are essential to overcome this. Short-term focus. Humans have a natural bias toward immediate rewards over long-term benefits. This often manifests in cost management as choosing quick fixes over sustainable solutions. For example, cutting training budgets provides immediate savings but can increase costs long-term through reduced efficiency and higher turnover. Organizations need to actively counter this bias through incentives and culture. Designing behaviorally smart cost systems. Understanding these behavioral factors allows organizations to design more effective cost management approaches. Here are some key principles: transparency and communication. Clear communication about cost management goals, methods, and results helps build trust and engagement. When people understand why certain measures are being tracked and how the data will be used, they're more likely to participate constructively versus gaming the system. Participative approaches. Involving employees in designing and implementing cost management systems increases buy-in and surfaces practical insights from those closest to the work. This can be done through techniques like participatory budgeting or employee suggestion programs for efficiency improvements. Progressive implementation. Rather than implementing complex systems all at once, taking an incremental approach allows time for behavior change and learning. Starting with simpler measures and gradually adding sophistication helps build capability and acceptance. Recommendations for implementation. Organizations looking to improve their behavioral cost accounting should consider these key steps. Assess current state. Start by understanding existing behavioral patterns and cultural factors influencing cost management in your organization. Look for both formal and informal practices that may help or hinder effectiveness. Conduct surveys and interviews to gather insights about how people currently think about and manage costs. Build capability. Invest in training and development to help managers and employees understand both technical and behavioral aspects of cost management. Focus on building problem-solving capabilities versus just teaching procedures. Create opportunities for practice and feedback in applying new approaches. Create supporting systems. Design integrated approaches that align structure, process, technology, and culture to support desired cost management behaviors. Ensure incentives and performance management reinforce strategic objectives. Regularly review and update systems based on observed behaviors and outcomes. Conclusion. The human factor is often the difference between success and failure in cost management initiatives. By understanding and actively addressing behavioral aspects alongside technical considerations, organizations can develop more effective approaches that drive sustainable results. The field of behavioral cost accounting provides crucial insights for this journey, helping create systems that work with human nature rather than against it. Success in cost management requires moving beyond purely technical solutions to address the complex human dynamics at play. Organizations that invest in understanding and actively managing behavioral factors will be better positioned to achieve their cost objectives while maintaining employee engagement and organizational health.